IFEG pattern trade of the week. In this series, I'm going to break down pattern trades so you can learn to recognize them and remove them from your trading. This trade from Thursday is based off a retracement into a 5-minute gap, followed by a 1-minute inversion to the upside. As you can see, this trade goes break even, but it's not a trade worth putting risk on for. I'm going to show you everything against this trade and why you shouldn't have taken it. The first thing I want you to notice is the fact that we left stacked lows at our stop loss. This isn't something I would always care that much about, but with the higher time frame context, in this case, it is. Zooming out to the higher time frame, we see we left unfilled 30 and 15-minute bullish fair value gaps. This gives price a reason to come mitigate our stop loss and trade lower. The 5-minute gap that you're framing prices out of is also extremely premium. We're very likely to come mitigate these stops, especially if there's not obvious buy side resting above. At all-time highs, you can typically get away with longing in a premium, but you want to see a specific scenario play out. Number one, you want to see some type of liquidity generation. There needs to be a reason for price to trade higher. Then you need to see some type of clear manipulation, ideally putting in an SMT and not leaving an unfilled gap directly at your stop. Remember, the IFEG is the last piece of the puzzle. You need the higher time frame context supporting that inversion.